Morning on that rebound. Take a look at futures for stocks today. We are expecting to see a higher opening for the broader averages. Of course, we were a lot stronger this time yesterday, and actually the market ended lower. So the question is, do we hold at stronger levels this morning, as we are expecting about a 60-point rise for the Dow, about 20 points higher on the NASDAQ. Joining the conversation right now is Strategist's chief investment strategist, Jason Trennert. Jason, good to have you on the program. Welcome.
Thanks for having me.
Wild swings last 2 weeks. What do you want to do here?
I think if you're a long-term investor, I think you want to be buying. I think you want to be putting more money to work in the market, and that's mainly because the operating theme, which has been there is no alternative, is still very much in place. If you're running a big pool of money, a pension endowment, a foundation, and you have actuarial assumptions of 7 or 8%, there's really no other place, in my opinion, to get it. You certainly can't get it from sovereign bond yields. It's private equity, I think, is largely done. You're going to have to go to riskier assets like stocks, which come with it more volatility. Maybe,
but I mean, given the volatility, these wild swings down 1,000, up 200, I mean, does that indicate that this market is not done selling off yet?
Probably.
That the nervousness is there, and maybe you want to just take to the sidelines for a little bit?
And again, this is it was almost 4 years before we had a 10% correction in the market, which is extremely unusual. It was the third longest period without a 10% correction in the S&P index's history.
Right.
This is becoming more. I have the feeling that the market's just becoming more normal, which is more volatile. Certainly, I think if you get greater clarity on what the Fed is doing, if you get greater confidence that China isn't going into a hard landing, which we don't think it is, I think the market will stabilize. But it could take another couple of months before those things happen.
We got to talk about the Federal Reserve, but let me get to your comprehensive report that you've just authored on the consumer. Let's talk about that, Russ. The title is The Hangover. What are you saying in this report?
Well, we're saying that you have a better environment for the U.S. consumer. You've got a stronger labor market. You have some modest acceleration in wages, but there's a big caveat. And the caveat is, if your definition of normal is what the U.S. consumer looked like in the 70s, the 80s, the 90s, we may not be going back to that. And the reason is you've got some longer-term headwinds. And one of those headwinds, maybe the biggest one, is that for many, many decades, a lot of the growth in consumption outpaced the growth in income, and that was financed by a declining savings rate, and it was financed by debt. Both of those trends are arguably at an end. We don't think the savings rate is going to go down very much, and maybe more importantly, it is very unlikely that the U.S. consumer can go back to borrowing the way they did 20 or 30 years ago. And in the absence of that, you have to have more modest expectations for what consumption looks like.
It's a great point, because Dagan has been making the point for a while now that we are going to see the results of the drop-off in gasoline prices, and that's going to empower the consumer, and they'll spend more. But you say today it's a different consumer because of what they've been doing. Savings rates up to 5%.
Savings rates up. And again, I do think that lower gasoline prices will at the margin help. But first of all, you've seen that willingness to save rather than spend the windfall from lower gasoline. Right. And just go back to a couple simple numbers on the debt. For many decades, consumers were having an average growth in household credit of about 9% a year. Since the financial crisis, that number is closer to 1%. That is the absence of a very big tailwind. And that's the big difference right now.
It actually creates a harder working society. My mother blames a selfish generation or generations of young people, spoiled, self-centered, and lazy, on debt, on parents who went into debt to buy automobiles, went into debt to buy their kids whatever they wanted. So maybe, I mean, that's the positive.
Although the funny thing is, you can maybe try this on your mother. That cycle actually began decades ago.
No, it happened. It started in the 80s, right?
Well, even further back than that, you saw that initial surge in debt in the 60s, the 70s. It's been going on for quite some time.
I'm, of course, not part of that at all.
How do you see it, Jason?
Well,
is this going to be a consumer-led recovery or a business-led recovery?
My own opinion is that it's more likely from here to be a consumer-led recovery. Although I'm very much in agreement with Russ. You're not going to go back simply because of the availability of debt. You're not going to go back to the way you were before. One other thing I would add, besides the high savings rate, lower commodity prices, a bottom in wages, is the fact that household formation is also bottom. That tends to be a very good leading indicator for economic growth. One other thing I would say, in my company, we employ 52 people. We had our annual healthcare meeting, which sucks the oxygen out of the entire company.
Why?
because premiums continue to go up.
That's where they're putting their money. This is such an important point.
It bums me out as a guy who owns my own business because you're working very hard to pay people more and doing all these things, and then you get hit with 18 to 20% types of increases in your premium.
Wow.
We have a small company, we don't have a large company. So, and we're switching like a lot of other companies to very high deductible plans. That could be another reason why the savings rate is staying higher, because people in a sense are self-insuring to a certain extent.
But that is a really interesting point. You mentioned 52 employees. A lot has been said about the significance of that 50 threshold.
Oh, yeah.
Was that something that impacted your thinking on that 50th hire?
It obviously didn't, because we went over 50, and at a certain point you say you just have to grow the company and you have to take the consequences. But it's not. It's kind of anti-capitalist to say I'm going to stop at 49.
Right.
I mean,
you would give
insurance
anyway.
Yeah, I know. So we pay about 75% as the company of our employees' healthcare expenses, but this is something where every year we've been hit with 18 to 20% increases, and we have to work that down, because it's obviously not sustainable.
I think you're so right. That's certainly where a lot of the money is. So you would buy stocks here after this volatility that we saw. What about you, Russ? Do you also want to allocate to equities here, or are you waiting?
I think you do want to allocate to equities, but with a couple of caveats. The first of which I agree with Jason. This period of unusually low volatility is over. The price of that higher return is more risk. The second is where you allocate. The U.S. market is certainly more reasonable than it was, but we still see better bargains overseas.
Overseas, like Japan and Europe?
Europe in particular right now.
Europe in particular. You like Europe?
I like Europe. We did an equity risk premium screen, and clearly Europe comes out on top. Japan, though, I think is also very interesting.
Jason, it's great to have you on the show today.
Thank you for having me. I appreciate it.
Thank you so much for joining us.
Thank you.
Jason Trennert.